don't know if I'm late, but welcome. I just saw the chat. Welcome to the Mortgage and Home Buying Made Simple webinar offered by SISIP Financial in collaboration with our longtime partner, Enriched Academy. Enriched Academy is a leading Canadian financial education provider offering engaging online learning, live events, and coaching that help people build practical money skills and long-term financial confidence. You might be familiar with the Money Mastery Portal, the platform that helps CAF members strengthen their financial health with accessible, action-oriented learning. That platform has been built in partnership with Enriched Academy. And if you haven't enrolled in our programs yet, today is a good day to start your financial education journey. My name is Jerome. I'm an investment fund advisor. I spent 13 years in the CAF as an infantry and IT roles before moving into financial services. Now at SISIP Financial, I'm glad to be back working with CAF members and helping them navigate their financial goals. I'll be your host today. My co-presenter is Jay Seabrook, co-founder of Enriched Academy. Jay began teaching financial education 25 years ago to high school student and has been an avid investor since his early 20s. He's now one of Canada's most sought after personal finance speakers and has been featured on radio and television programs, including Dragon's Den. Over to you, Jay.
Hey, thanks so much, Jerome. Yeah, looking forward to going through this training today. I'll pass it back over to you and do a bit more of an intro, as I pick it up.
Perfect. So here's a quick overview of what we'll be covering today. We'll walk through the home buying process from start to finish. We'll touch the main government programs that support first-time buyers, followed by a brief comparison of renting versus buying, and the tools available to help evaluate both. We'll finish with considerations specific to our defense community, including relocation realities and mortgage advantage available through CDCB. The disclaimer, before we get into the presentation, please take a look at our standard disclaimer. Just like we would consult different healthcare providers for our different needs, it's important to have a financial support team that knows you and your needs well and can help you put what you learned today into action. One of the best examples is us at SISIP. Just a few seconds. Okay, perfect. In case anyone is unfamiliar, SISIP Financial is dedicated of supporting financial health and security of every CAF members in the Canadian Armed Forces community. Our mission is to contribute to operational readiness by providing tailored advice and product solutions that enhance financial health and security for CAF members and their family. We understand the unique realities of military life, frequent posting, deployments, and benefits specific to CAF members. Our solutions are designed with these factors in mind, ensuring advice and product that truly fit the military context. You can, next slide. They are aspects of financial that can be complex, such as taxation, investment and inflation risk, income generation, and income replacement. SISIP financial advisors understand military lifestyles, are qualified, and are here to serve you and your family. You can switch. And finally, SISIP Financial is a team of advisors located across Canada in different bases and wings, offering advice and solutions such as insurance, financial planning, savings and investment, and counseling. This webinar is designed for CAF members, but much of the information applies to everyone across Canada. We'll highlight a few CAF-specific nuances during the presentation. But now, let's hear from you, Jay Seabrook. Over to you, Jay.
Hey, thanks so much again, Jerome, for the setup here. Just so everyone knows, this is a live training, so we love to answer questions as you have them today if we can. So there is a Q&A icon. It should be up on your screen there. Feel free to click that and enter questions. If we don't answer the question right live, we will at the very end of the training. But we love making these interactive, and our goal is just that you get as much value for you as possible from this training today. A lot of you are probably first-time home buyers, right? That's what attracted you to this training. Some of you might already own a property and you're just looking to get new information around real estate and real estate investing, and just also more familiar with all the tools that SISIP through Enriched Academy offer you. So we're going to cover all of that here today in this session. Now, I wanted to start with this slide, and the reason that I did is because this is the reality for a lot of folks when it comes to buying their first home. And the reality is that a lot of people get a little bit shocked when they buy their first home, because it's not just about having the down payment. There are other considerations. So my goal and our goal with SISIP today is that we de-stress when you buy your first home, and you have a better base of knowledge going into buying your first home. All right. Now, let's just look at real estate. Let's back up for a second. Let's look at real estate as an investment vehicle. Now, real estate has historically been quite a strong investment, right? Go back to 1980. This is your average home sale price in 1980. You could actually buy the average house across Canada. This is your average across Canada price, $66,000. Wow. It has changed, right? But then it went up to 80,000. And you can see these 5-year increments, how the price has changed. Now, today, it would cost you $652,000. This is the latest data available. This is your average home sale price, maybe not where you live, but across all of Canada. And what's interesting is that home prices have actually come down from the peak in 2022. In February, they peaked out, and there's been about a 21% drop in your average home sale price. So it's actually a much better time to buy a property now than it was a few years ago, that's for sure. Now, what you need to know, again, big picture, is real estate has been quite a safe investment, right? And it's grown roughly 6% per year on average. So, obviously the last few years has come down, but sometimes it's gone up really fast. Like in a market, it'll go up 15 or 20% in a year, which is crazy, but it's happened. But this is your average. Now, looking at other ways to tie up your money. And this is showing you the growth of $100 at different interest rate growth over a long period of time. All right. So just for fun, if you put $100 into a checking account and just let it sit in there, and you left it there for 100 years, what would that money be worth 100 years later at 0% growth? You could probably do the math on that, right? It would still be $100. So it doesn't grow. Now, if you have your money sitting in a savings account, and let's say that they're paying you 1.5%, your $100 would have grown to $443. Inflation, the problem is you have inflation always making things more expensive, right? And so what used to cost you $100 100 years ago, today costs you $2,000 for that exact same thing. So when you have your money working for you, it's in bonds, real estate, stocks, because that's where you're going above inflation. And you can see bonds at 5%, that's what the money would have grown to. Real estate, that's home values only at 6%. That's how much the money would have grown. Stocks at 9%, which is roughly, depending on what you look at with stocks, but that's roughly what you would, how much it grows. Investment real estate, that's where you actually make money renting part of your property out. 10% plus has easily been the historical average. So, there's a lot of folks traditionally in Canada that are very pro real estate. Does that mean it's for absolutely everybody to go and buy a property? And the answer, I would say, is no. It depends on you. And there are books like this one here. It's called the Wealthy Renter. So I've read, like, as someone that's a real estate investor for over 20 years, bought multiple properties, still own multiple investment properties. I would read this just to get a different perspective. And what we would say, and this is an interesting read, right? But if you look at how does it really look for you? One of the tools that you're going to get access to, that you have access to through SISIP, and at the very end, we'll talk about how you can download this. But we have a tool, and we have many tools here available for you. It's just something that you get. And we have this one tool, it's called the Rent versus Buy Analyzer. And you can download this onto your own computer, and it looks like this. Now, the idea here with this tool is you make the right choice for you. Let's take all the emotion out of real estate investing, and let's just look at the numbers. So the nice thing about this is okay, if you're going to buy a house, how much would you pay for it? So you just put in your numbers here, how much down payment. I'm going to talk about this stuff later as well. And then on the right-hand side, you have, what if you just kept renting, right? And then what does it look like for you financially, depending on where you're buying and what you're like, all the considerations are captured by this tool. And it helps you make a logical choice on if buying is the right move for you. Like if you're someone that's definitely relocating quite often, unless you want to hold that property after you relocate as an investment, you probably don't want to buy, right? As an example. So you got to look at this for yourself. It's hard for me to give individual advice, obviously, in something like this, but that's tools to help you. And again, we'll talk about the portal at the end, but you can download this. All right. Now, let's walk through the home buying process. We're going to do it step by step. We're going to start with step one, and these steps are meant to be in order. You really need to start with step one before you can go to step two. All right. And this is the big barrier, I would say, for most people. What gets in between them and their dream of home ownership is that down payment, right? It's a lot of money. Now, if you're buying a $500,000 home or condo or whatever, just to make the math easy, I'll use $500,000. Maybe it's less where you are, right? Which is great. But if looking at the math on this, you probably have heard, I think, you need 20% down. All right. So if that was the case, you would need $100,000 down payment, which is a lot of money to get saved. And that would also mean you would have an 80% mortgage. So this is pretty traditional. A lot of lenders, there are more options available if you have 20% down. And if you did, that means you'd have $400,000 of that would be a loan that a mortgage provider would give you. All right. Now, more people are doing this. And like how I bought my first home is I used a 5% down payment. And so I only need, you need to come up with a lot less. On a $500,000 home, it's only $25,000, which is still a lot of money, but it's a lot more attainable. And then you have what's called mortgage insurance. So there are some different providers, CMHC, some of us have probably heard of them or them. What they do is essentially tell the lender that if you default, that they're going to actually look after their costs. So the lender will say, oh, okay, I'm comfortable with them lending a 95% plus because I know CMHC is going to look after me if this home buyer isn't able to make the payments. Now you pay for that service. So this shows you what the fee is right here on $500K, about $18,000. But then they just put it into your mortgage. So your mortgage is higher. And it looks like this, but again, you're going to be able to get into that house a lot sooner. I did this. I'm so glad I did because it got me started with owning real estate a lot quicker than I could have otherwise. Now, for you, what we would suggest that you would do is to understand better how much you need to save in order to get into that first home. Like right now, we know if you're here right now, there's a lot, some of you again own a property already, but there's a lot of you that don't. And you're like, how do I get a property? It's real, like, and that you don't have this down payment saved right now. We would just recommend that you nail down how much do you need to start saving of every paycheck in order to get yourself to that goal. And if you don't start saving that money, you're just never going to get there, right? That's just being realistic with it. So how do you do that? So this is just a simple example. You can screenshot this and then do it for yourself. But let's say you're 25 years old and you want to get into your own home by 30, as an example. That's 5 years from now. Let's say that you're trying to buy a property that's $500,000. And so if you're only putting 5% down, you need $25,000 for that down payment. How much do you already have saved? For some of you, maybe you have nothing saved yet. So that means you need to save that $25,000, right? And that's $5,000 a year. So if you kind of fill this sheet out gradually, that's your goal. Okay, I got to save $5,000 roughly per year. And if you're making $50,000 right now, okay, so that means I need to save 10% of every paycheck that I get. I need to figure out how to live on 90%, and I need to make sure this money is set aside and it stays aside, all right, is the key thing. So do this for yourself is what we would recommend. Fill this sheet out for you. And to nail down that savings goal, it will help you a lot. Now, just know that there is quite a bit of help for first-time home buyers. All right, and these are I wish I knew about this these things. And I wish some of them were available to me. When I bought my first home over 25 years ago, a lot of this stuff, some of it's newer, and some of it you need to know about, or you kind of miss out on it. All right. So I'll show you how it works. So are these different things, and they like using these long names for these things. But you might want to just jot this down so you can look it up a bit more after this training. But it's called the first time home buyer's tax credit. They name it in a way where you instantly will fall asleep when you read it, right? But and you forget to even apply for this, right? Is what happens. But this is something where you basically the government will give you money back on your tax return, $1,500 when you first buy a house, but you have to put it into your tax return or have somebody do it. Whoever's doing your tax return, make sure they know about it so they can put it into your tax return. And so if you owe $2,000 in tax, as an example, you're going to get this credit and now owe only $500. This is just simple math on how it works. But you can see I'm not going to read through all of this, but write this down and make sure you take advantage of this. So if you don't put this into your tax return, you don't get it, right? So it's not like the government just does it for you. And anytime you can get your hands on a $1,000 plus bill, take it, right? So there you go. There's one of them. First-time home buyers plan. So if you're someone that's currently using an RRSP, which we know, there's only a percentage of you that probably are on here, like less than half typically, is what we see. So this won't apply to everybody, but you can use your RRSP. And again, you're getting tax savings on, like, when you put money into it, it lowers your tax that year. So you get a better refund check. So they're really good kind of money, free-ish money that's there for the government. So you try to use that. But you can take money, once you have that set up, you can take up to $60K per person. So if you're a couple, you could take $120K out of your RSP, and then you don't get taxed on that money, but you do have to put the money back in. But you can save thousands of dollars. You can see this is just a very high example here, but where you're not having to pay that on the investment gain. All right. So again, it's a little bit technical. You might want to set up a meeting with SISIP to talk about this sort of thing. And SISIP advisors, they're here to help you, right? But this, like, where you get individual guidance to learn more, that might be a spot to do it if you're a little unsure. Now, the government's recently created this other program, and it's called a tax-free first home savings account. So if you don't have an RRSP yet, and you're like, okay, I know I'm going to start saving some of my money. I got to, if I'm going to buy a house. We'd highly recommend you open up one of these accounts. And you can do this with your financial institution. They'll help you set this up, right? And what happens is when you put money into it, you put in $8,000 per year, you don't get taxed on that money. So you get a way bigger refund. And then when you take the money out, up to $40,000 to buy that first house, any growth on the investments while they're invested over that time, you don't pay tax on. So it's like, it's brand new. It's only in 2023. So this is like showing you just some quick math where you can save $10K in tax. You're going to get this money back, like $10,000, like thousands of dollars bills sitting there if you use this. So make sure if you don't have this already, and especially people that don't have an RRSP, but you're definitely going to buy a house, use this first. This isn't one size fits all advice, but usually that would be the case. Start that. It's such a good account. So again, make sure, hopefully you wrote down those names and get a little more guidance if you need it. All right. Now let's go to step 2. So step 1, that's the biggest barrier that keeps people from buying a house. That's why we want to start there. Step 2, we're going to talk to speaking to a BMO mortgage specialist. And I'm going to hand it back to Jerome here in a second. Before I do, just know that a mortgage specialist, they're fantastic resources to help you understand what you can afford. Really, it's like the bridge between you, the specialist would be the bridge between you and the bank. And they're in your court. They're trying to help you get a mortgage done, and they're trying to help get you into your home because they know that's your goal, right? So I'm going to pass it over in a second here to Jerome, but they're going to let you know what you can afford, which is certainly something you want to know before you go home shopping. So over to you, Jerome.
Yes, thank you, Jay. So basically, I have a quick slide about the BMO special. Just to clarify, I do not work for BMO, but you guys need to be aware of benefits you have through BMO as far as bank account and all that. But in this case, in terms of, mortgages, I'm not gonna go through the slide in detail. Basically, the key takeaway here is you have advantage on interest rate. I think you basically have the employee rate at BMO. Again, I guess it depends on your credit score and all that, but huge savings back in your pockets when you use BMO as your mortgage split bank, for example. In terms right now, the only difference, as you see on the screen, is really the posted rate versus the mortgage rate that you would have. Just keep in mind you save a lot of money by dealing with BMO. You can go to the next slide. If you have any question, by the way, about BMO, I suggest contact a mortgage specialist about that. They'll be able to answer your question a bit more in detail than I am. There's also a few things, and I saw a lot of questions in the chat already about this, specifically the key relocation benefit that can influence your mortgage. Again, I think I'm going to keep it short. You see the 3 links here. I invite you to go on there because that's where you'll be able to find your answers. There's so many fine prints about that, and I'm going a little bit off script right now, but just because I saw a lot of questions about it. CAF policies may reimburse interest on short-term loans and bridge financing when you are relocated. Also, I also saw a question about penalties. Mortgage breaking penalties and mortgage default insurance are not always reimbursed. So it's important to budget those costs when relocating. Sometimes these out-of-pocket expenses can affect your finance, or choose a different down payment size that can also affect that. There's also benefits on transferring mortgage without penalties and keeping that same interest rate if you're posted. Really helpful. There's also the house hunting trip, HHT. Many of you are probably aware. The relocation directive covers major home purchase support tied to house hunting trip, including travel, accommodation, and that helps you make a better assessment and decision for your next house. The Canadian Forces Housing Differential offers financial aid for high-cost regions, impacting mortgage affordability within safe debt limit. Again, that within safe debt limit, I'll take for example, I'm in Quebec and I'm posted in Ottawa, which is way more expensive than here. Some costs can be covered if you're not able to kind of transfer one for one and have to purchase a house at higher price than you would here. So in general, just keep an eye, go on these websites, really helpful. And I cannot answer, and I'll try to answer in the chat, by the way, but it's so case by case and specific to your situation. So don't expect to know everything now, but I highly suggest go on these websites, and they're pretty well made.
Yeah, awesome.
Over to
Thanks,
you.
Jerome.
Go back to you, Jay. Thank you.
Yeah, sounds good. So yeah, I think you get the one-on-one guidance, right? Get the meeting with the specialist, and see what that looks like. And there are other options as well for you, right? So, but you want to start there. Now, what do lenders look at? Like, what would get in the way of you getting financing to actually buy that house? So let's start to understand what this will look like for you. All right, now, I'm going to order these as well. I'm going to try to order them as much as possible with sort of most important down. Now, again, this isn't always one size fits all, but credit is going to be very important, your credit score. All right. Now, 650 will get you approved usually, not always. There's different nuances. I'll explain them. But 700 plus will typically get you better rates. Lenders also look at usage history, like how you're using your credit. So I'll walk you through that, but just know it breaks down like this. Like, you want to have a strong credit score before you even try to get a mortgage. I would suggest that you're going to get your credit score. You can your different banks offer it. You can get your credit score today for free through a lot of different sources. understand what that is. If you know you're below that 700, call it, credit score, you're going to want to get that built back up again to then get the best possible rates. Now, if you don't get the best rates, it can cost you more. All right. So the rate impact 720 plus, you're going to not pay more money essentially to be able to get a mortgage. Now, when your credit score is lower than that, below 720, it can start to affect how much you pay. All right, in extra interest. Someone that's lower, call it 600 to 649, could be paying $48,000 more in because they have that 1 or 2% higher rate. It can start to look like this. So again, it's not like definitive hard line. There's a bit of gray here with all of this, but that's why you want to make sure you keep a very strong credit score. Now, secondly, the lenders are going to look at your debt. If you're somebody that you have 3 credit cards, a car loan, a student loan, you have all these different debts that they can see, they're going to look at those debts against how much you can afford, essentially. So there's something called the GDS and TDS, sort of use these acronyms for you. But the lender wants you to be in a situation with your bills. I don't know if anyone's ever been this excited about their bills before, but they certainly don't want you to look like this individual here, where they give you a mortgage and now your back's against the wall and it's super stressful for you, right? So because of that, they're going to start looking at you and they're going to look at a couple of different ratios. Some of them pick one and not the other. But the 2 big ratios are this. One's called I'm going to use the full name, the gross debt service ratio. So they're going to look at what your mortgage payment would be if you bought the property that you want, plus the property taxes, heating, and if you're in a condo, some of the condo fee. They're going to divide that by your annual income before tax, and then they want that number to come out at 39% or less. Now, this other ratio, why do they have 2? I don't know. The lenders are different. I don't know if it was because they were trying to make this confusing or not, but there's something called the total debt service ratio. And the big difference with that one is they're going to add other debt payments. So you see a lot of lenders will use this, and that's when your student loan, your car loan, all of that will fall into it. So, and there are a lot of lenders that use this, right? So when they divide it, the number, they're going to look for higher here, 44% or less. So there are lots of good calculators online where you can do this. And this was a good one. It's the Government of Canada, and it just helps you run the numbers quickly for yourself. So you can actually figure out what your GDS and TDS is before you meet with a broker, potentially. You can do this with the broker, but if you want to know where you stand, it's not a bad thing to get a handle on in advance. And you can see if the green check boxes when you calculate down here. So this is someone that falls well within the thresholds there to be able to buy that property. All right. Now, income. They really like steady income lenders. All right. So you're in a good position because you are with obviously a fantastic organization that's very, very stable and steady. They know your check is going to keep coming in. They don't like people like me as much because I'm self-employed. I'm a bit scary for lenders. My income can fluctuate. If you're a commission person, they don't like those people as much. They love steady, stable income coming in. Lots of employment history with one employer. They really like that. They'll actually contact your employer. They'll actually contact past employers sometimes. They just like folks that have this steady, this is us showing, steady income just rolling in gradually over time, right? So that will help you, but just know that they're going to pull lots of documents, and they're going to this is what shocks people, I think, when they first try to buy a property. They ask you for all these documents. They're like, we need your NOA. And I remember when a lender asked me that's notice of assessment. You get it after your tax return. I didn't know what they were talking about, right? So I wish someone prepared me, but just when you get a tax return, you got to keep everything now if you're going to get ready to buy a house, or they'll have to find it. You'll have to dig it up because they're going to want even to see your bank statements and all this stuff. All right. So just know that is normal. Unfortunately, there's a bit of pain in that, but it's kind of seems worse than it is. Like once you do it, it's done and it's straightforward. All right. They're going to look at, hey, do you have things like investments? They're going to look at your, again, different debts that you have. Where are you going to get that down payment from? If your parents are going to help you, they want proof of that, right? They'll even look at their bank balances and things like that. So these are just showing you different, like this is showing you an investment statement. This is showing you a tax assessment for a property. So just be prepared for that. And the value gets confirmed by an appraisal, usually, but not always, or automated valuation. And here's the thing to know is that you might have a spectacular vision for this property here, and you can get it at a smoking good deal. And you're going to actually put a hot tub in the back, and it's going to be a beautiful porch and spectacular. There's going to be a koi fish pond into a river or something. I don't know. I'm just making stuff up. But you have this glorious vision for this property. The lender isn't going to see that. They're going to see this. All right. They like properties that they feel like they could sell if something went sideways. That's the truth, right? They're like, will I be able to sell this if this person stops paying us? Basically. So they like things that, like established property, solid foundation, all that kind of stuff. So they sometimes will have it again. They automate the appraisal a lot of times. Sometimes, though, they will have an appraisal done on a property. All right. So that's a lot in step one and step two. The next few steps go a little bit faster. I'm not trying to scare you out of buying a property right now. It might kind of seem like that, but we're mostly just trying to prepare you and fill in the void if you've never looked at this before. Okay. Now, step three, you could do step three earlier for the record. But this is, again, your logical kind of way to look at it. This is by far the most fun part of this whole process. And some of you, you're already looking at properties before you've done step two or whatever else, or you're not quite done saving your down payment yet. And that's totally fine. If it helps motivate you to then save more money, that's brilliant, right? So, but when you start looking for properties, MLS, I mean, realtor.ca, that's your best really outlet for it. Obviously, you probably know realtors, that sort of thing, and they're different folks, but it's good. Like if you're years out from buying a property, I would suggest that you start looking, even now. And the reason is because you just get smarter about the market the more you look at it. All right, so there's no harm in that, and you can use Zillow, you can use realtor.ca. They have great apps, and you can just mess around, and you just get a lot more wise. And then when you see deals pop up and you're like, oh, that's the place, right? When you start looking at it over time. Okay. So that's step three. Step four. Now, we wanted to prepare you for this. All right. Because when you speak to a mortgage specialist on step two, they're going to ask you for a lot of documents to better understand you. A good specialist will ask you a lot of questions. So again, they're not trying to put you into something that isn't going to work for you. They're trying to get you where you want to go. And they want you to be in a good position to be able to afford the mortgage, that kind of thing. So they're going to start getting paperwork because the lenders, they'll get like a pre-approval. That's where the lender's like, yep, we'll probably approve. It's like they're not, we're guaranteed going to approve this. They're like, yep, we'll most likely approve this. That's kind of what a pre-approval is in some cases, because then when you're finalizing the mortgages, they can sometimes surprise you, right? And so when they do their employment and income verification, sometimes they don't, for the record, and it's quite straightforward. Other times they're like, actually, we're going to need this letter of employment done, like where they didn't ask for it before, and now you have to come up with some new document, right? Personal finance, like maybe hey, we just want to check, because it's been 3 months since we got you approved, and now you're getting close to getting the house. We want to check your bank statement again, just in case, right? And it's just like, oh, shoot, I didn't know we were going to have to do that, right? So just when that happens, like down payment verification, property details, other properties owned, they might surprise you, sometimes not, but just there is a finalization that will happen. And then there's this closing process, all right, which is step 5. Now, a question we often get is this. How much should you budget for closing costs? And we're going to, because there are other small expenses that add up when you buy a property that shock people, because a lot of us are like, oh, I just need the down payment pretty much, right? But I'll show you, I'll kind of walk you through them. And our recommendation is that you would have 3 to 5%. 5 is really a lot to have sitting in the bank based on your property that you're buying. to help you cover those expenses. That's very high typically. Even some people are like, you just need 1.5%. I say aim for 3 to 5%. Then you'll have this cushion there, because when you buy that property, you might want to do some work on it. You're going to have to buy some things that you didn't maybe always expect. But know that there's legal fees. Like these types of things were a shocker for me when I first bought my first property, because I knew, hey, everything's going to this lawyer because you have to sign off on it. There's the legal documents where you now own the house and it's legal. I didn't realize that I actually had to pay for that, right? Like, call me naive or whatever, but it's not like anyone teaches you this. So the first time I bought a house, it was like, oh, shoot, I have to come up with $500 for a lawyer or what? Sometimes you have to pay land transfer tax. This is the big one for the record. All right. Now, you might get a rebate, but I'll show you what this looks like depending on your province. A home inspection. So if you're buying a house and you're buying, especially an older house, you want to get a home inspection because they will find things that maybe you didn't see. And that's their whole life. They'll spend like half a day at a property just to find issues with it. And then you're using that to maybe even talk down the price a little bit when you buy. But you definitely want to do that because there could be a big surprise that you're now, without that, you're going to get shocked by it. The only time where you wouldn't do this would be condo buildings. Typically, again, it varies in a newer condo, that sort of thing. Appraisal, sometimes the lender will pull that. Again, that's where they're just making sure the value of the property. Sometimes you have to pay that though too. Land survey. So these are all the things that could come up. All right. So we're just trying to make you mentally aware of it. This one's big if it's a new build. All right, new home GST, but a lot of us, if we're buying a place that isn't brand new, you won't have to worry about. So this is looking at the rebate. All right, now, so you can see this is a good calculator. It's on Wawa. You could just look it up, land transfer tax calculator, and this will come up, and you can see what the land transfer tax will be where you live, and you can put in like how much of a property you're going to buy. So this can be shocking to people. So check this out. Like, I know the second time I bought a property, I didn't get a rebate of any kind, and it was a lot of cash to come up with for the land transfer tax. All right. The last step is the home is yours. You're getting the keys. Very, very, very exciting time in life. And so that has taken you through, a lot of the steps and what to be aware of. Now, we're going to transition and we're going to go to some questions here shortly. So before we do, I just throw out, this is a great time to to ask any question you might have. We're going to do our very best to answer your questions if you start typing them in here. But before we do that, just as a little break here, know that there are other tools available to you through the SISIP Enriched Academy portal. This one's really, really cool. Because like as someone that's been a real estate investor for years, I still use this tool that you have for free with SISIP in Enriched, where you can download this sheet. It's a little intense, but you start to calculate in all your expenses in advance of buying the property. Like a lot of us don't know, if you've never bought a house before, you don't know that you have to pay insurance every single year, right? And insurance can be thousands of dollars, or it is typically. Maybe you have an electric bill, you have a water bill, you have a heating bill, all that kind of stuff. So when you start to wrap your head around that, and you can use something like this to better help you understand your payments and everything in advance. This is like a bonus step, I would call it. This isn't for everybody. There's a lot here. But as a real estate investor, we have a lot of real estate investors using this tool all the time when they buy when they buy investment properties as well. And you can actually see the return on your investment that you'll get on average buying a property. So I use this every time I buy an investment property, and I've analyzed hundreds of properties using this tool. It's pretty awesome. So wanted you to know about that. So to condense the action steps before we get to, I'm going to turn it back over to Jerome in a second, and then we'll get into your questions. Let's just summarize everything here for you in one spot, make it really simple. So step one, it would be, if you haven't done it already, run your numbers in the rent versus buy calculator. When does it make sense for you to even buy if you haven't bought yet? That's a great place to start, step one. Step two, what's that realistic goal for saving your down payment, right? How much do you need to save? Nail that down for you. I gave you a broad sense of it today. what really matters here is yourself, right? And what you're going to do with this information. So that's an excellent second step for some of us to take. 3 is find a fantastic mortgage broker. All right. Now, again, you have a great resource with the BMO channel that's available to you. For other people, they might also be open to meeting other brokers. That's up to you. All right. But it makes sense because of the relationship with BMO. Just start there. All right. Remember to tap into government help. Don't forget that. I went over it. It's technical. Sorry if it wasn't exactly straightforward. It's quite technical, those government programs. But remember, first-time home buyers plan. Remember tax-free first home savings account. Remember those things, and make sure you try to tap into those. All right. And lastly, know your total closing costs and your monthly carrying costs before buying. Like you definitely want a sense of what your closing costs will be. So again, we covered that in the training. And then what's it going to cost you just to keep the property? If you start paying property tax, you start paying insurance, hydro bill, that sort of stuff. And that's what that one calculator can help you with. So Jerome, I think I'll turn it back over to you for this slide here.
Thank you, Jay. Before we get to the question portion of the webinar, I just wanted to talk about the Money Mastery Portal. This is a free resource designed for CAF members and their family. When you sign up, you get access to 6 learning modules, practical tools, webinars, and articles tailored for you and manage your finance with confidence. Registration is easy and quite fast within about 60 seconds. In order to be easier. No, it's okay. It's okay. We added the QR code
Sorry, bud.
for this slide,
you up there.
just so you can go straight to the portal. So you can rewatch the slide after. So it's free and it's for you. I highly suggest to use it. About the question, I've seen a lot of question. Well, I don't know if I'll just give me a sec. I'll just update that. I want to ask you, Jay, some question that I saw that you might be in a better position to answer. One of them was, oh my God, sorry, I lost it. Sorry, it's Britannia, I think. Oh, if I qualify as a first-time homeowner, but my husband does not, would that affect my option for first-time home buyer's credit? Can you answer
that? Credit will just apply. Yeah, for you, like you're still able to do that. So I'm assuming you want to put the property just underneath your name, if I'm understanding correctly. So there's a bit more to that that I would need to know. But you are able to, like, let's say that individual just wants to buy themselves, they can still use that home buyer tax credit for sure.
Okay, but if they buy with husband, that wouldn't count, I assume? They wouldn't be able to?
If that person's name isn't on title, I would just check that. Actually, I'm not 100% sure on that. If they're not on titles, that's a good question. Yeah.
And do you know a little bit more about foreclosure homes? If
you have a line on buying, you can sometimes get an excellent deal on a foreclosed home. I'm not sure where your source is. But if you do have opportunities, they're worth checking out for sure. I just wouldn't get, like, there could be a lot, they're not always straightforward. So just like I think we mentioned in the training, is that you want to start educating yourself in that market you want to buy in. Even if you're a year or 2 or 5 years out, I'd start looking a little bit just you're going to just get more familiar with what a good deal is and what a bad deal is. So I'd say as long as you've done that first, and if you have a way to, like, you're going to see the good deal and then be able to act on it.
I'll answer. Yeah, there's just one that popped up. PO2 Soto. The question is, I heard first home savings account, I assume they talk about the FHSA, is also available to those who already own a property, but have not lived in it for a certain period of time. Is it correct? Yes, in a sense. Technically, in order to open the account, you need not to be to own and live in your property as a main residence. Technically, on paper, I think maybe from what I understand, if you own a rental property and haven't lived in it for 4 or 5 years, I think 5 years, let's say, you would be entitled to open it, because let's say you're renting right now. because you need to be occupant of that house in order to not be eligible. If it's about our RSP, in order to what's the term, HBT, home buyer plan, I think.
Yeah, where you
HB,
borrow money
HDB.
out of it. Yep.
This one might be different though. Maybe you know it a little bit more, Jay.
Yeah, I mean, if you're using that later on, yep, you certainly can. Yep.
Yep.
Yeah, that's the.
If you guys have any question, you can raise your hand and we'll unmute you if you want to ask it verbally.
We have some other questions here too. I had one.
Oh yeah, go ahead.
This is from Huey. Thanks for this question, Huey. You said, how long do you have to file for the first time home buyer's tax credit? We bought our first home 5 years ago and didn't apply. Yeah, so it must be claimed the tax year you bought the house, but you can work with your accountant and go back and basically correct that old tax return. Just make sure what you're going to spend for your accountant to do that is going to be worth it by the time you get the money back. But they can go back and adjust it, just so you know. But that's a really good question, Huey. And that's why we put that training in here too, because I didn't know about things like that when I bought a house either. So for those of you, a lot of you that haven't bought a house, make sure you note this, because again, that's hundreds of dollars, maybe over $1,000 for you that you get back. So first time home buyers tax credit, HBTC, that's the acronym for it. Excellent. Do you have any fresh questions? Yeah, go ahead.
I have a fresh question, and it's more, I think it's going to be more of your opinion, Jay, but I also have a big opinion on that, so I might jump in. From Sergeant Howard, in your opinion, with extra money / bonuses, is it better to invest in a TFSA or pay down mortgage? What would you suggest, Jay?
Yeah, so I'm debt allergic, so I'm the wrong. I'm like, I just want to wipe out. It was a priority for me early in life to pay my mortgage off. There's a lot of good arguments not to do that, because you can borrow money for, call it 4 or 5%, and you can invest money for, call it 8%. So you can take, so we actually teach people how to do it with Enriched Academy. It's called leveraging equity, where you use the equity in your house as essentially a way to build more wealth. That's going to totally depend on you. Personally, I personally don't do it. Even with rental properties, I don't do it. I let my rental properties just pay themselves down. And it's crazy. If you run the math on it, you're better to build wealth faster, to actually use that money to invest. So that's just one point of view. There you go.
No, it's I share the same opinion as Jay, by the way. Even as an investment advisor, I'm not allergic to debt, but I'll always focus on debt before. You guys know, in the Army, you receive lots of VAC amounts for injuries or whatnot. Every time I have a client in front of me, I'll make sure that, okay, do you have debt to pay? Can you put more on your mortgage without penalty? Do you have, and I'll try to use that money on debt prior to invest. Yes, you might be able to gain more than it costs you to have a mortgage, for example, like borrow at 5%, 4%, and make 8, 9%. But in general, like Jay said, my opinion is the same. I always pay down debt before investing, even as an investment. I like doing that, but I'll always pay down debt prior. It will create you more freedom, I think, in the future, and you'll thank yourself by doing that. We had the question, Luke, you can unmute yourself and ask the question.
Hi guys, thanks for the great seminar. Just a quick question that relates to that as well. I'm just having a hard time deciding how much money to put down to keep my monthly mortgage payment as low as possible and still be able to save money. It's all situational, of course, to the person, but I'm in a good spot where I could invest more than 20%, and just looking for some strategy or advice on how to do that the best way.
Yeah, like Luke, myself, my own perspective, because you're saying, hey, I could put down 5%, and then I have money, but my mortgage will be higher. Well, I'll have less down payment. I can use some of that money for investing. or I put down a higher amount so I have a lower payment, and you're kind of stuck on what to do, just to clarify.
Yeah,
right?
exactly. Like I could even go more and go 30% down payment, and then
Yeah.
I'd still be able to save money monthly. It's just it's a big decision. It's tricky.
I fully understand that. I mean, yeah, like a lot of folks, like you're not doing the 5% thing unless you sort of have to. You're doing 20%. That's certainly the standard out there that most people follow. Do you want to put down even more so you have that lower payment? It kind of goes back to that debt allergic thing or not, like, and how aggressive you want to be with investing, Luke. So it's hard. Like it could be a good actually opportunity to book with a SISIP advisor and chat with them and get their take on what to do after they ask you some more questions. Like it's tough for me. Like with us with Enriched, like we would ask a lot of questions before I would give you advice individually on that, just for the record. So.
Yeah, I'll
Great.
chime in
Thank you. I
for
appreciate it.
Yeah, no
Luke,
worries.
if you don't mind. I would do the same thing. I think there's a lot of questions to be asked before taking a decision. But generally, in my opinion, if you have the money to put down 20%, why put 5% and accept to pay like a 4% to an insurance? So basically, it's, in my opinion, throw money away. Since you already have it. So yeah, I would put 20%, probably not more, and only keep. Most banks will allow you to put 10 or 15% every year as added payment without penalty of breaking the mortgage, and I would stick to that and invest the rest, and then go from there. That would be my opinion. I'll jump to Rob. You can unmute yourself. Rob, are you there? Rob? Okay, we'll go to another question right now. Do you have some, Jay?
I do. Yeah, let me just pull. We had some before the webinar, actually. Somebody asked, what about buying a house in Italy? So I like that just because it's fun. Because some of us have heard anyways, that you can actually, the government there, because their population's declining, in certain villages will actually sell you a house for like $1. And these have been advertised around. Essentially, they're trying to get people to move to the village because people are leaving the village and they need the tax revenue, and no one's paying the property tax there anymore. So they're like, come to our place. You get to live in Italy. It's beautiful. And it's going to cost you very little to buy the house. So that's just an interesting question. Like certainly with, we have international options available to us, especially in retirement. So I would just always say due diligence on that, because sometimes those houses in Italy, as an example, that seem like they're really cheap, haven't been lived in for 7 years and they're in rough shape, and you're going to have to put in a certain amount of money just to even want to move into the place, right? That kind of thing. So diligence would always be the key with that question. Another question we had was, so do we panic and sell in Oakville given the world issues? We bought in 2003 for $226K, and now the house is worth roughly $1 million or 1.3. And just wondering, like what they should do. And we would just say, like, my stance is this: real estate has been quite solid here in Canada. It's been obviously a poor investment for 4 years, but look at it just in the last 4 years. If you're buying at the peak, right? If you bought 10 years ago, you're still nicely up right now. Would I expect real estate values to continue to go up at 6% per year? And I am going to say no, definitively. And the reason, and that's what we've been historically. And the reason is simply supply and demand. Like part of the reason that your real estate market is soft, we're soft here in Canada right now, is because they've limited immigration. The reason we were going nuts 3-4 years ago, partially, was because we were immigrating at record levels. So now that that's slowed down, the real estate market's got a lot softer. All right. So, but again, like even in a place like Japan, they've been losing population in Japan since like the 90s, or early mid 2000s and 90s they started. And so real estate values have not gone up as much, but they're still going up like 2-3% per year. So again, we see it being historic. Again, in the future, good investment. Do I think the values will go up as high as they have previously? I would say most likely not, because of there's going to be most likely less immigration coming up. All right.
I have a question.
Another question. Oh, sorry. Go ahead. Go ahead.
Yeah, I have one question I would like to touch from Warren Trudell. He says, none of you have provided advice on debt to service ratio to ensure we are buying within our means and not putting ourselves at financial risk. From the last question, 30-year amortization is available only when making 25-30% down payment. What should we do?
You're asking about debt ratio. I thought we covered it, but I'll go back to the slide share here. Current slide. Oh. Let me just skip up. Debt ratio. I believe this is what you're talking about. So we covered it earlier. I'm not sure when you came on, but this is how your debt ratios work and where you want to be targeted. And you can check out this again. This government calculator can be quite useful. Just put Government of Canada debt ratio calculation. This calculator will come up and you can run numbers on that. But yeah, that's here. We covered kind of midway in the presentation.
Okay. Virgin, you can unmute for your question.
Yeah, gentlemen, just because I personally lived through this situation, I moved to Ontario. My wife became a student and was also on parental, so her finances were basically zero. I came at the height of market back in 2019. We got a mortgage, basically of pre-approved of 500, or basically they gave us 375, and then they approved our purchase at 575. So we had to sit down, being like, why are you allowing us 200,000 above what you quoted us for a mortgage? And they basically went 42%. And this is BMO. We sat down because my wife finances were basically zero. They looked at my income, my salary, and because we had no debt, no cars that were on loan or anything, basically they gave us a house on 42% debt ratio for us to take on this mortgage.
Okay. Yep. Great. Awesome. Yeah. And so there's not with lending and getting mortgages, that sort of thing. They do move around a little bit. There's gray area there, which is, yeah, you'll find out kind of as you go through it, and everyone's a little different as you shared. Appreciate that sharing.
There's 1 minute left. I think we're going to go with closing. I don't know if we'll be able to answer your question after that, but I suggest to contact SISIP or mortgage specialists if you have other questions about that. I would like to thank you, Jay, for joining us today. We appreciate it. And of course, and to help you, to help us make webinars even better, there's going to be a post-webinar survey that will be emailed to you all soon. Just keep in mind, there's 5 participants of this webinar that will be receiving a gift card. So it's randomly selected. 5 Canex gift card will be offered, one at $500, one at $300, and 3 at $100 each. You guys will be in touch who won the prizes in approximately 10 business days. Looking forward to seeing you on the next webinar in April. It's going to be dedicated to teaching your kids about money with CPA Canada. Jay, do you have any last words?
No, thanks so much, everyone. Really appreciate it. It's an honor getting to work with this group. We love what you guys do. Thanks so much for everything you're doing for us.
Thank you very much, all. Bye.